recorded. We will start recording right now. It is also being translated into French and Spanish. So if you want to see or hear the workshop in French or Spanish, please click on the menu item on your Zoom screen that says interpretation. And there you can select the language of your choice. It is being translated into French and Spanish. You also have the choice to stay in the original language. And if you do this, you will hear people as they speak in either French, English, or Spanish. So if you want to hear the entire workshop in English, please go to interpretation and also select English. So let's move to the next slide. So here is our agenda for today. This workshop is divided in two parts. Part 1 will run until 10:30, and we will focus on sharing CGAP learnings from our recent MFI digitization pilots. We encourage you to post all your questions in the chat so that we can go over them in our Q&A session. In part 2, we'll change gears a little bit, and we will hear from MFIs that have participated in the pilots and also from CGAP project partners. We'll hear about their experiences in the two different pilots, in the credit renewal automation pilot and in the business intelligence pilots. But before we proceed, we'd like to start with a few polls so that we get a better sense of who is in the audience and of what your role is in regards to digitization. So please take a look at your screen and select. For the first poll, please select one answer to this question. What category best reflects who you are? So we'll take a minute and then look at the results.
So people will need to go to slido.com, right, and type the CGAP code, or they will need to scan the QR code to bring them to the app.
Correct, and thank you, Ivo.
And by the way, just to say that this will apply throughout the presentation, so just stay on the Slido. If you're using a different device, you type slido.com, type the CGAP code, and then new questions will pop up as we ask them. So you don't need to close the window or application if you're already there.
Okay, so we'll give you one more minute and then take a look at who we have in the room. Okay. Danielle, can we take a look at the results? Okay, so we have overwhelmingly microfinance providers. So this is great. Thank you so much for participating in this poll. We'll have many other polls in this workshop. Next, we wanted to hear about what you are doing to support microfinance digitization. So if we could move to the next poll. And so here you have several options, grants. So on the funding side, are you supporting microfinance digitization by providing funding, grants, equity, debt, or technical assistance? Or are you facilitating partnerships? So here we recognize that you may be playing various roles. So please select all the answers that apply. We'll give you again 1 more minute, and then we will close this poll. Okay, I think we can close the poll, Danielle. Thank you so much again for participating. So most of you, as you see on the screen, are providing technical assistance to support digitization, and also facilitating partnerships is not negligible at 30%. So thanks again. That's great to see who is here. Now let's kick off part 1 of this webinar. And Danielle, if you can move to the next slide. I'll introduce quickly the various speakers. So first, my name is Isabel Beres. I'm the Community of Practice Lead for the CGAP MFI Digitization Project. And I've managed our group engagement with the organizations that have participated in the project for the past couple of years. I'll be moderating the virtual workshop today. In part 1, we will hear from a few project members. First, Xavier Faz, who is the lead financial specialist at CGAP. He leads CGAP work on technology and business models in digital finance, and he has been a key advisor in the project. Ivo Genik is a senior financial specialist at CGAP. As the CGAP MFI Digitization Project Manager, he has overseen the entire project. Mark Fleming is a development specialist with over 25 years of international experience in developing financial institutions, and he is the project technical lead for both pilot work streams, for both the credit automation and the business intelligence work streams. The other project team members, Thomas Carrier from Rubix and Kei Niang, will take part in part 2 of the virtual workshop, so you'll hear from them a little bit later. We can move on. So now I will hand it over to Xavier Faz for some opening remarks.
Good morning, everyone. Good night, good evening, wherever you are. It's great to have you here. I will be brief. I just want to provide a few comments for context of this work. Technology is changing very rapidly, and in the last decade, the financial inclusion discussion has been primarily or largely dominated by the talk of emerging new business models and their potential to advance financial inclusion. We talk a lot about fintechs, platforms, digital banks, and others. While these models can be very promising, a common constraint they face is the ability to reach lower income entrepreneurs effectively. Digital businesses often struggle getting the tech and touch right. The touch part is something that microfinance has gotten right. The relationship model, the proximity, the ability to understand and build trust with customers in order to serve them well. These and other factors have turned microfinance into the main source of finance for hundreds of millions of individuals and micro entrepreneurs worldwide. Microfinance has been a source to both resilience and growth of entrepreneurs at the grassroots of our economies. Crises after crises, we see that people remain steady and resilient thanks in large part to the support of MFIs. Microfinance has demonstrated that it can create value sustainably, both for the end customers and for investors. In the past few years, CGAP undertook an effort to investigate whether technology can transform microfinance. Is there a microfinance 2.0 kind of model that supersedes the traditional model? Can technology have a significant impact in the way microfinance performs? We have done a lot of work on this, as many others. We are not the only ones who have worked on this space in terms of exploring the way technology can change microfinance. So building on efforts that exist across markets and doing our own research and experimentation, we have found very positive results. First, we spoke to dozens of microfinance institutions worldwide to understand what successes and challenges they were facing in their digitization efforts. And we found that only a few had really been successful articulating the kind of impact that their digitization efforts had and measuring the kind of impact. And we found that primarily the successes that we could measure were the ones that were driven by business initiatives. Business-driven initiatives were really the differentiator in making effective use of technologies to improve the business and to serve clients better. Based on those observations, we developed some principles and guidance, and we created a community of practice. And we're going to talk a lot more about this to test these principles and to learn what can be effective ways to incorporate technology and improve the business of microfinance. Coming out of this effort, our thesis is that technology applied in a focused manner can create business efficiencies and enable new avenues for growth, creating value for both the customers and the microfinance stakeholders as well. But taking a little bit of a step back and looking at things more in the big picture, there are many reasons why we should pursue the digitization of microfinance. First of all, digitization positions institutions to more effectively expand their portfolio of products and services. Given the multiple crises that affect the world today, increased inflation, climate change, economic downturns, food insecurity, customers are increasingly facing new challenges, and they need a variety of new services that traditional microfinance models may not be able to provide. So that is a very strong reason why it's important to digitize, to be able to expand the portfolio of products to better meet the needs of people, of customers now. Another important reason is that microfinance institutions need to be more competitive to stay ahead of the game and to be relevant. New providers are entering the space, especially fintechs, offering products that are often more flexible or better suited to meet the needs of customers. To remain in the market, microfinance institutions need to up their game, so to speak. Digitization can help institutions adopt new channels and service models that are more efficient and convenient to customers and can make their services much more competitive. Lastly, there is an increasing opportunity in markets to grow through partnerships. The formal financial system across emerging markets is becoming more open and modularized, which means that there is more space for different kinds of institutions to play a role in the provision of finance. Microfinance digitization, microfinance institutions that digitize could become an access point for a variety of products offered by other institutions in the market, such as mortgages, longer-term lending, and other more sophisticated products for trade. So in essence, the formal financial system is changing and is creating new opportunities for MFIs to plug in and be part of that broader ecosystem. There is a place in that bigger puzzle that MFIs should fill. And the implication of that is that MFIs, through partnerships, would be able to transform their business model and expand the portfolio of services that they can offer. So again, this takes us back to the conclusion that adopting technology is key for the future of microfinance. The question is how? How can MFIs do this effectively? And this is the focus of the session this morning, to talk about and share with you what we've learned about the process of trying to do this with different kinds of institutions. And we hope that these insights and lessons can inspire you in whatever role you play in the microfinance ecosystems to continue supporting the transformation of microfinance. That's it for me. So go back to Isabel to continue and kick it off.
Great. Thanks so much, Xavier, for these words. So we will actually go back to the agenda for just a few minutes. Some of you joined after we had gone through this. So just want to give you a sense of how we are breaking out those two different sessions. Part one, again, is to really present the work that we did in the pilots, how we structured the work with the individual institutions in cohort one, and then as a group to support many more institutions in a one-to-many model afterwards with cohort 2, and then also what we've learned, as Xavier just mentioned. That is the focus until 10:30. After 10:30, we really encourage those of you who can stay on to do so, because we will get into more of the details for each work stream. On one hand, for the automation of loan renewal, and on the other hand, for the business intelligence. And we will have a chance to see how we structured the support to a group of MFIs, and hear directly from some of the MFIs that participated in the project. And this is where we will hear from Peter Accordion from Action Microfinance Bank in Nigeria, and from Imran Hamed from Shakti Foundation in Bangladesh. We will also, in that second part of the program, break out into sessions, into 2 different breakout sessions, so that there's ample time for questions and for digging deeper on those 2 topics. So now let's go back to our program. And here we wanted to again present you with a question. So you've heard a lot from Xavier on why CGAP did this work and what were the expectations, and now we'll hear what we learned. We would love, before getting into the project, we'd love to hear from you on how you see digitization intertwined with the future of microfinance. So if you could just answer this very simple poll, do you see digitization intertwined with the future of microfinance? And just yes, no, or unsure. Just take a few minutes, please. It's probably worth mentioning also that we use the term digitization loosely. So we really use it to encompass the concept of digitalization as well, not just going from analog to digital data, but also moving processes to digital technologies. So please keep that in mind also as you answer this question. We are speaking broadly about digitization, digitalization as well. Even 1 more minute. And again, for those of you joining, in order to answer the poll, you can either scan this QR code or go to slido.com and then put the keyword CGAP. And keep it open for the entire session. We will have a few other polls. Okay, so overwhelming yes, that's good to hear. We're all on the same page that digitization is critical for the future of microfinance. So now let's move ahead to our core agenda. I'm going to invite Ivo and Mark so that they can share more about the work that CGAP has done in the last couple of years and what we have learned about how to create value with digitization. So Ivo, I'm handing it over to you.
Thank you very much, Isabel. Thank you, Javier, for your opening remarks. Ladies and gentlemen, it's a great pleasure to see such an interest in this topic and the consensus that digitization indeed is the future of microfinance. It's also a great honor to have the opportunity to present the work. My name is Ivo Inik. As Isabel mentioned, I've been managing this project, and I'm going to tell you in a few minutes what exactly we've done and sort of the main takeaways we took away from our work before I hand over to Mark, who will walk you through much more details about what we're seeing. So when we started this work about 2 years ago, one of the first questions we tried to answer was, what is successful digitization? What does a successful digitization look like? And we have done, or we did a pretty robust landscaping to look for different cases of MFIs digitizing using technology for all sorts of purposes. And what we were looking for at that time was digitization that A, creates a value for the customers and for the business, and B, that value is measurable, can be explained and described in a quantitative terms. And so with this kind of criteria in mind, and we will be coming back to that concept of value and what value is and how value get created through digitization, we found a handful of microfinance institutions that could tell us exactly what they did with technology, how did they digitize, and what impact that digitization has had on their business and on their customers. Of course, we found many more microfinance institutions sharing their stories and experience with digitization. But those 5 we thought were great examples of a successful digitization efforts. And so we published a case study where you can find more detailed information about what they did and how they did it. But what you see on the right side of your screen is sort of a summary or some highlights of what that value that they created was. So some examples: 27% increase in loan officers' productivity. And of course, we could kind of extend it and go deeper and say what that increase meant specifically for the business, for the customers. Did it allow, for example, Bank EMEA to grow the portfolio or dedicate more of the loan officers' time to something else? 50% decrease in loan processing time. Again, a great indication of value created. And again, we could go deeper and say what that decrease means for the customers, for the business. Doubling on year-on-year basis, almost doubling use of digital channels by women. Same for annual increase in transactions made by women. Streamlining a significant portion of credit renewals. Another great example of what digitization can do for microfinance institutions. So with what these examples are meant to illustrate is that digitization indeed can have a very tangible, measurable impact that we call value in this case, and that this kind of impact we believe can be replicated. And so using those 5 examples and the case studies, we have articulated 5 principles, next slide please, of what we think is, or 5 principles that can guide a successful digital product development, or simply successful digitization. And now these 5 principles we think are also fairly universal and can be applied to different types of digital efforts and by different types of microfinance institutions. Yet, while being universal, they are also quite applicable or practical if you want. While they may sound sort of high level and maybe too abstract, in fact, they can be very easily translated, in our view, into a practical guidance for any digital implementation or a lot of digital implementation efforts, which is something that we've tried to test it out in our own community of practice with 28 different microfinance institutions. So let me give you just a very brief summary of what those principles are, and then we can get deeper into how we've observed those principles being applied throughout our pilots. So principle number 1 is resource and empower the product development team. Now that may sound very obvious and generic, but we of course know that very often the big digitization vision, strategic decision is made at the top level by a C-suite of microfinance institutions. But the actual implementation, the actual day-to-day execution and decision-making power should be really bestowed upon the product development team. And it is not a technical IT team. It is the team that is responsible for developing and very often then implementing the product, because these are the people who know the business, who know the customers, and who are best positioned to kind of follow also the rest of the principles here. Principle number 2, define and measure the value you aspire to create. So again, we will be coming back to this notion of value, because it is almost the core message or finding of our work, that without value, no digitization really makes sense. But defining and measuring value needs to be concrete enough. It is probably not sufficient to say we're digitizing to make our services more convenient to customers. It's important to know what that convenience means for the customer and what that customer's convenience means for your business. It's not enough to say that we're digitizing because we want to make our business more efficient. It's important to know what that efficiency actually means in terms of numbers, in terms of business growth, in terms of portfolio quality, and so on. So again, this high-level principle has also very concrete implications for how it should be implemented. Principle number 3, prioritize product features that create value. Almost every digital implementation comes with a suite of important decisions that the implementing team needs to make. It's very similar to when you are renovating a house, let's say, when you need to choose your windows and flooring and doorknobs, but not all of these decisions are of same importance, and not all of these decisions, using the house sort of proxy, will have the same impact on how you feel about the house and what is the house value. Same with digital implementation. You will need to make a lot of decisions, but only some of them are really essential because they directly help to create the value that you've defined at the very beginning. Principle number 4, test prototypes with simple technology. It's almost a common practice for digital players, for fintechs, for the newcomers to have this agile, prototype-based, minimum viable product-based product development. It's not yet common practice among microfinance institutions, but we find it's very important because it helps you to spread out resources as you implement a digital solution, but also get a very quick response to what you're building from your customers and iterate the product over and over until you get it to the stage where you can start scaling up. And principle number 5, create a good user experience for everyone. Again, may sound too obvious, but what it really means is one of the key principles of change management, helping not only your end users, your end customers to benefit from the digital implementation, but also your internal customers, your field officers, your back office people who are not maybe always in minds of implementation team, but who are essential for successful implementation of digital technology and scale up, because they will be the users. And if they don't see the value, how the implementation makes their lives better, then it may be very hard for them to really embrace it, and you will need to deal with a lot of sort of resistance. And so we believe those 5 principles, again, are fairly universal, and more importantly, they are sort of realistic to follow. And that's why also the title of this session, A Realistic Pathway to Big Dreams. So what we've done, next slide, please. We took those 5 principles and we decided to test them out in practical implementation. So we've partnered with 5 microfinance institutions with whom we've implemented a credit renewal automation process or automation solution. So automating the credit renewals, and we've done pilots with all of them, successfully completing all of those pilots. And we then partner also with 23 microfinance institutions with whom we worked on improving their data analytics and overall business intelligence in response or in relation to their different digital implementations. So on one hand, we have a fairly consistent set of 5 MFIs doing the same thing, streamlining their credit automation, renewal automation, and on the other hand, we have 23 MFIs with different implementations in place, but using business intelligence to better understand how those implementations are going, what needs to be improved, and how they can further iterate the digital implementation to basically improve the solution. And so what you will see is what are the results and how those 5 principles stood the test of these 28 MFIs, trying to implement them in a very practical settings. The last point I say before handing over to Mark, next slide, is that we've tried to cover a diversity of contexts and MFIs so that we get a good sense of how those principles and digital implementations could be potentially impacted by other factors such as legal and regulatory framework, maturity of the market, the infrastructure, customer base, and so on. So we have a pretty diverse sample in this community of 28 microfinance institutions. So now let's hear from Mark about how the pilot test went and what we've learned from the process.
Hello, everyone. Happy to join this. Yeah, as Ivo said, these pilots that we did were very much a test of an approach to implementing digital initiatives. And even taking a step back out of our research, while we found some cases of successful implementation, And these principles in this approach to implementation are very much derived from that success. Our major finding in our research in general has been that there is an extremely high failure rate. There is a very high rate of institutions, and this is not just microfinance institutions, this is banks broadly, who invest a lot of money in digital technology, but do not generate value for customers and business that they can measure. So this exercise is very much a test of an implementation approach. The roadmap is the, let's say, core framework for implementation. Those of you who do agile product development will recognize this. This is a very sort of standard agile approach to product development. As we move from project setup, let's say the hypothesis of what is the problem we are trying to solve and why do we think this solution will solve that problem. Your business intelligence that backs that up, product design, your minimum viable product build out. So you have your prototype and then the sprint. We'll come back to this later, but normally there are multiple sprints as you move through the testing. So I'm going to walk through this, and what I'd like to do for you is a few things. One is to explain how the principles are implemented so that this is very practical. The second thing is to explain what the 5 microfinance institutions who did the loan automation, what decisions they made and how they did it. And third, reflect a bit on the lessons that we learned that we think are good takeaways for those of you interested in doing this next. So number one, and in the bottom, you're going to see the principle, and on this timeline, you're going to see where it fits and when you make those decisions in the various phases of project implementation. So in project setup, when we issued the request for proposals, we very much asked for companies willing to set up a product team with enough time to actually implement the product. This comes down to really the most basic question. It is very, very common at the middle of initiative for, at a high level, the C-suite to decide, okay, hey, we're going to build this new product. And so the head of business takes it on. And the real question about effectiveness is there a product team who's dedicated to this full time? And does that product team have the authority to make decisions on a day-to-day basis without going back and checking with the C-suite or with the risk department to ask what they're doing? And this may sound assertive, aggressive, but I invite you to reflect on this as we move through this, because it's very common to assign new products to, people who already have full-time day jobs. And after you think about everything that one has to do in this process, you ask yourself whether or not someone can do this who doesn't have full time to do it. Let's move to the next phase. So in the very first formulation of any product development, it's like there is a point where you're saying, okay, we believe that if we make this product defined this way, X, Y, Z, it's going to solve this problem for customers and they're going to love it. And it's going to build into a business line. Now, in our case, when we issued the RFP, that was already predefined. We said we are interested in testing out automating loan renewals. That means that MFIs who, as customers finish off their loans, that you can write basically software that will generate an automatic loan approval and automate the process, extend the offer to the customer, accept their answer, and generate the loan. And everyone who applied for this, and I think there were over 125, and everyone who joined this believed that. They believed that so much. In fact, we all believed it so much that we said, yeah, of course, of course, we're going to do this because loan renewals are 70% of our monthly loan disbursements. And so absolutely, we believe that if we can automate loan renewals, that it will be faster for the client and we will gain efficiencies and we will make more money. Categorically, yes. The only thing that we want to make sure is that this model and the particular model that we were using was we hired a software as service provider, Rubix, who you'll hear from later, who came to this with a decisioning model. And so which we commonly refer to as algorithms sometimes. And so all of the MFIs approach this thinking like, absolutely, if we can make this work, we're going to make money off of it. Customers are going to love it, but we have to make sure that this model works. That is that when it says that we should make a loan to this person and it approves a loan, that person's going to pay us back. And so right from the get-go, that was the assumption, the hypothesis, and it was just basically, we are super convinced we need to know that this model doesn't generate bad loans. Okay, now, the good news is that all of the institutions completed this process, and all of the institutions had better loan repayment requirements in their automated loans than they had in their traditional loan. So, mad success, everybody happy. But what we're going to do now is that we're going to spend a little more time than we spent diving into the business intelligence hypothesis part of it and asking the question a little more in a more granular way. How exactly were we going to see customer behavior change by creating this new product? And how exactly was it going to create better business value? Because the number one finding we have out of this is that there were, in fact, other features of the product that are going to generate value for customer in the business. Now, all of the companies who completed their test, all of the MFIs, are moving on to testing those other features of the product. But we want to signal them here for those of you thinking about doing this, because we think there is, quite frankly, a faster way to do this. All right, let's jump to the next slide. Okay, the business intelligence part of it. Just giving you two examples of slides, dashboards that we used to take a look at this. So this is, before automating loans, this is taking a look at the loan portfolio and saying, what can we say about customer behavior? And this graph on the left is a customer journey graph. And what this graph does is it takes all the customers in a financial institution and it says, okay, what do they do in the first 24 months when they join the institution? So all of the customers are here. And what this particular graph says is that on the horizontal axis, those are the months, those are the 24 months. What this says is that in the first month, about 20% of all customers make a transaction and 80% don't. And then as the customers move through their first 24 months with the institutions, you see that the number of customers who don't make any transactions increases. And at the end of 24 months, there is a very, very, very small percentage of customers that remain transacting. So in other words, in this particular case, we are seeing very, very high inactive rates. Now, we have seen cases like this that are extremely successful. Institutions growing their balance sheet, increasing return on equity. But underlying that is an extremely high rate of customer inactivity, meaning that some customers are coming on and loving the service and going on and becoming very, very, very active customers. But the majority of customers are not, they're dropping off. So that is, I'm showing you this particular dashboard because this is very common across the microfinance institutions that we've seen in all of our research. The second graph here to the right is a loan renewal rate, and that is just saying, hey, for any customer who paid their loan off in the last 6 months, how many of them renewed their loan? And you see in this particular case, a drop. a drop that started just as COVID started. And then so many MFIs experienced this, but bottom line, what you're seeing is a drop in customers not coming back for follow-up loans. Now, there's many other kinds of business intelligence that you do. I'm just picking these two for reasons that will become clear when we dive into the business case. But let's just remember these: high inactive rates, low rates of loan renewal from customers. Next slide. Now, while we all believe that, automating loan renewals is going to create huge efficiency gains, we dove into the mechanics of this. It's like, exactly how is that going to happen? And I'm just going to stay high level on this, but I'm going to point something out, I think, that is going to allow us to tie this together. If you look in the first column that says traditional, this is basically as a baseline saying, for example, if you have an MFI and each commercial officer disperses 15 loans every month, 5 of them first loans and 10 of them follow-up loans. We make certain assumptions about average loan size and and the salary of a loan officer. And you'll see down below in this example, the average outstanding portfolio of a credit officer is 165 loans with almost $250,000. And the expense to income ratio, and that's only counting the loan officer's salary, is 20%. Now, if you automate those loans, half of them, 50% of the loans, which is, you can see that in 5 first loans, 5 traditional follow-up loans, and 5 automated loans, the commercial officer is now saving a bunch of time because it takes much less time to do these automated loans. And but there's no change in the business value, because just because the credit officer spends less time doesn't mean that they use the time productively. And if you look at the 2 columns on the right, what you see is different scenarios in which we say, okay, well, if the credit officer spends that extra time saved in making more first-time loans, that's column 3, you get at the end of the day a 13% increase in the portfolio and a 2% drop in the expense to income ratio. So you gain efficiency, you gain productivity, and you gain portfolio growth and income growth. If you're super aggressive and you use the automated system to automate as many follow-up loans as you can, you have a possibility of increasing loan growth almost geometrically. It's talking about 160% increase in loan portfolio and a drastic drop in your income to expense ratio. Now, what this says is this: we can make money by automating our loans if the credit officers make more loans, or if we make more loans with this automated system. But that means a couple of things. That means that the demand for your loans has to increase. In fact, it has to increase a lot. You need to have either more first-time customers coming to you, or you need to have a lot more people renewing their loans with you. So the business case, what it says to you is, for this to work, my credit officers have to become way more productive. Yeah, we can save their time, but they've got to convert that time into more loans. And B, my customers have to like my product a lot more than they like it today, because I need a lot more customers walking through the door for first-time loans, and I need significantly more customers renewing their loans. And also, I need to be able to automate most of my follow-up loans, like more than 50%, or at least 50%. Okay? That's what this business intelligence tells us. Now, let's go to the next slide. When we say, the feature, it's like, okay, when it comes down to designing your product, you need to prioritize the product features that create value. That's what's going to make the thing work. And a big part of that is going to be creating a good user experience. So now let me back up. What the MFIs did, as I said, is they believed so passionately, yes, we are going to create value out of this. We just have to make sure that the loan, that this model works. We need confidence that this model works. So they tested it and it did. But let's take a step back now and look at what we just learned out of this little business intelligence exercise. What we learned in that business intelligence exercise is that the success drivers in this product are not loan loss. Loan loss is just a risk mitigation feature. What will make this product work is if customers love it more, if my commercial officers love it more, and if we can make loans to 50% of our customers. Now, all of the MFIs in this violet said, okay, we really want to test this out, so we're only going to lend money to our A and B customers. So the loan model basically scores customers on how well they paid you in the past. And if they paid you really, really well with no late loans, they're an A. And if there was some deviation, there was a B, and then C and D customers. So all of the MFIs tested out these loans on A and B customers. And of course, all the A and B customers paid back. And we are extremely proud of these institutions. I mean, we really think it is an amazing thing that they completed these tests, in the 12 months. I'm really taking a step back now with what we learned along the way and saying, if you think about this, a model that just tells you who paid you back in the past, the customers that paid you back in the past are very likely going to pay you back in the future. In fact, previous loan repayment is the highest predictor of future loan repayment. So quite frankly, the possibility that these customers, these A and B customers that you lent to would not pay you back, that probability was extremely low. That's what the model told you. And so another way of looking at this is saying, like, okay, the things we need to test, we're going to find out whether these customers pay us back, but let's move on to the important tests. The important test is, can we make customers love it more? And can we actually disperse these loans to our C and D clients? Because for most MFIs, only 30% of their customers are in the A and B category. The real challenge is using the automated loan system to disperse to C customers and to D customers, and to motivate those customers to pay back better the second time than they paid back the last time. That's where the challenge of this product is. And so when we say prioritize the product features that create value, and when we take a step back at this, we look at this and say, the real questions here were not like, will our good customers pay us back? They did. Of course they will. They always do. The real question is, how can we make the customers love it more? And how can we make the C and D customers use this when they take out this loan, pay back better? That is the core, and that will be the challenge to any of these loan automation initiatives. And that we can discuss that in the second session in the breakout sessions. But that gets interesting. There's ways of gamifying it. There's ways of creating loyalty programs. There's ways of using risk-based pricing, making the loan more productive. You can all reflect yourself on what you think you would have to do to make your loan more productive. But that is our number one takeaway from this, is that focusing early on just the product features that are going to drive value. And it's very often that you will only discover these things when you dive into the business case and when you do the business intelligence and really look at the customer behavior. Because if you remember in those graphs I showed you, if you're looking at very high inactive rates and very low loan renewal rates, you know that you actually have a pretty big challenge there. This isn't going to make you any money unless you solve those problems. And in the cases, in those graphs that I showed you, the problem was pretty big. Let's move on to MVP build out. Yeah, I think, Ivo has said this. We decided, we hired a firm, Rubik's, who you'll hear from, and they brought their software as service solution. And this drastically simplified there was no tech build out essentially for any of the implementations. And that gave the institutions time to focus on product development and focused on the tests. We also did this in a 12-month timeframe, which we think is also important. And so I think the proof of that is that we're here today having this discussion. In 12 months, each one of these institutions have results to look at. They actually stood this thing up, they implemented it, and they are looking at it. And each one of them has different results, and some of them are surprising. Some of them, all of a sudden, regulatory barriers show up that you didn't expect, or you find out you have issues with your core banking system that you need to fix. Whatever the discovery is, to make that discovery in 12 months and to do it fast has a very, very positive impact, let's just say, on the broader change management challenge of the institution. It is problems identified early can be corrected early before they cost too much. And once again, I want to say that, each one of these institutions was able to launch their sprint and is in that position now to be making their decisions about the next step. The next slide. So yes, in a agile product development process, you typically have multiple sprints, and that is in fact what these institutions will do. As I said, we in 12 months had time for one sprint. They used that sprint to validate the model, and the results were very positive. And now these other issues that I pointed to from the business intelligence about, okay, what do we need to do to make this product more attractive to customers? Because they have now results, they can see how customers responded to these automated loans. And in sprints 2, 3, and 4, and however many sprints they do, they will be testing out these other product features to get to success. So just to complete, I guess, the description, the implementation pieces, it was extremely important to have what in Agile is called the definition of done. We would just call it your objective. What does this look like when you are willing to scale it? Because that is typically what these tests are doing, is they are removing your doubts, and they are convincing you that, yes, we are now ready to scale this. We are now ready to deliver this to all of our customers. So yeah, I'm going to stop there. I know we have time for question and answers in a bit. But I just want to summarize again that overall, we feel like the fact that 5 institutions from around the world with very different kinds of tech stacks and products were able to implement this and do a proof of concept pilot in 12 months. We think that is a robust validation of our basic assumptions that it is very good to use software as service providers. It is very good to reduce the tech deficit. It is that this approach works. That's one big thing. The second is that we also see exactly in a much more granular fashion how value is created in a financial institution by automating its loan portfolio. We see the drivers. We see very clearly that it's not only about automating the loan decision, that it is about making the product more attractive to the customer. It is also about making the new job of the credit officer exciting for the credit officer, because they are going to move from essentially dispersing 15 loans a month to maybe 40. and making that so focusing on the customer experience, focusing on the user experience of the credit officer are the things that are going to drive the value. All right, I am going to stop there, turn this back. I believe we're going to do question and answers.
Yeah, thanks so much, Mark. Thanks so much, Mark and Ivo, for this detailed explanation of what we did during the project and what the key learnings were. So I see in the chat there are some comments about some of the principles that resonate, especially simple technology was called out by Brian Doyle. So I think that's it's great to hear that. I see there are a few comments about some of the challenges of that microfinance institutions and perhaps any institution may face as they are digitizing, and those are called out by Odile Mukariyanga. So thanks for putting those in the chat. I'd suggest maybe before opening it up to the Q&A, if we can get a bit more feedback from you also on what you feel are some of the challenges that are associated with digitization in microfinance, because certainly there's the solutions or the proposed solutions are also to compare or to look at in the context of the challenges that you are seeing in the various markets or instances where you have been supporting digitization. So we'd love to hear that, and then they'll give you time also to reflect on what you have heard from Ivo and Mark, and so think of your questions as well, and then we'll come to that. So we'll do a quick exercise here that is a little bit different than the polls that we have done. We'll do a word cloud, and Danielle will set that up. And what we would like you to do here is just to type in what are, in your view, the 1 to 5. So just try to summarize them. You may have many more that come to mind, but try to summarize the main challenges that you see in supporting effectively in really microfinance digitization being successful. So go ahead and type it in, and what this will do is basically surface some of the common key issues. So I see some of you are also typing your challenges in the chat. That is great as well. Just know if you type it in the actual word cloud, that will allow us to see if there are some common challenges that are coming up for people and surface them. But funding is coming up a few times, digital literacy, so challenges on the part of the adoption capacity from the client side is mentioned a few times in different ways, and digital literacy we see as coming up as one of the common issues, staff capacity and availability as well. So some of the more human aspects of digitization and embracing moving to digitization. That is coming up also in the chat, resistance to change. Then we have a few issues also that are linked to consumer protection, such as fraud. Ivo,
Isabel,
go ahead, your hand up.
I just want to make a comment on digital literacy. So this is just very anecdotal evidence, but we're also doing some demand side research with some of the MFIs that participated in our pilots, asking their customers what kind of difference they've observed if they were served through the digital channel as compared to the traditional one. And while digital literacy comes up, where customers say, you know, we don't like it because it's a new technology. I don't understand the technology. I prefer to deal with the loan officers face-to-face, etc. It's, and again, very anecdotal and from one institution for now, it's a very small portion of the responses. So this is to acknowledge that digital literacy is a problem, but I think it's really good to understand where exactly that problem is, who are exactly the customers that are struggling with digital literacy and what exactly they're struggling with, because, and I know that we're asking you just to type a phrase so you don't have a space for nuance, but there is an important nuance in what the digital literacy means. It's because depending on what it means, it could be addressed in various ways possibly. So I just wanted to make that comment that it's something that's come up in our research too.
Great. Yeah, thank you, Ivo, for that. So let's see, we'll give you still a few minutes and then we will give you an opportunity to ask questions, not just in the chat. Feel free also to raise your hand and we will give you the floor. Okay, so yeah, it's great to see what is coming up. Again, some issues that have to do with the capacity, with the data availability and the capacity to mine the data, and from the client perspective also to understand products that are data based, or what it means to interact with product rather than with the person, as we're seeing with the calling out of digital literacy. We do have funding that is coming up, and again, as I said before, also some of the consumer protection issues with fraud and cybersecurity. So if anything, I think what that highlights is a huge range of issues, with some that are likely to be more prevalent in some market than others, also depending on the context. So thank you for this. We will now close this, and we will take note also of everything that you've mentioned in the chat in terms of challenges as we put together kind of the final notes for this. So now let's move to the Q&A part of this session, and we had one hand up. Daniel, if you could help me find it. I saw a hand up and now I don't see it anymore.
It was Michael Ogba. You can now ask your question, Michael.
Oh, good afternoon, everyone.
Good afternoon. Yes, hello.
Okay, it's my pleasure to be here. Thank you for the presentations. I've enjoyed myself. I run a micro-lending institution in Lagos, Nigeria. And our vision is to be Nigeria's #1 non-bank micro-lending institution. So that takes me to the question I want to ask. So how do you, given the lean financials you have, or did I say the resources available to you, how do you marry data mining with and automating your system with the fact that the shareholders and the stakeholders require profit at the end of the day? Is there a cheaper way of automating your system, number one? Number two, is there a cheaper data mining app or program we can do? Those are my questions.
Okay, maybe I will hand over that question to Mark. I think that speaks to cheaper ways of approaching the technology needs. Mark,
Sure.
would you like to take a stab at that?
Yeah, excellent questions, because these are the first questions that typically have to be answered. We answered them in the following way. Because we had to work with 5 institutions across multiple jurisdictions, we chose a software as service provider. And that means, and Rubik's, that this is a software service provider that comes with a platform. And all it requires from a microfinance institution is to extract data out of their core banking system and upload it onto the Rubik's cloud-based platform. Now, there are other providers in the market as well, but just using this model, software as a service, what this does is eliminates all of your development costs. It eliminates the risks. It eliminates the time involved in actually building out the platform. Other companies have built out their own platform. It just takes longer. So I would say, number one finding from our experience is that if a company wants to build value by automating its loans, automating its loan renewals, a very good approach is to pick a software as a service provider and to launch the pilot and focus very specifically, again, on the profit drivers, which are going to be improvements to the loan product. And don't waste your time. Don't spend that initial time working on technology build-outs because they're complicated and they're expensive and there's a high failure rate. So I would say, number one, pick a software as a service provider. The issue of data, there are many different kinds of scoring models. The Rubik's model focuses very much on past repayment performance. They also often hook into credit bureau information. So there's lots of ways of combining different data sources. But the key to this particular approach is that every financial institution, every microfinance institution has this data. It's just sitting there in your core banking system, and it is not a complicated thing to extract it. So there's no mysterious data here. This is not complicated. Any microfinance institution has this data and can extract it and upload it onto a platform. So again, that is why we chose this model as an answer to your question. How can we do this as simple as possible in a way that can be replicated by the largest number of institutions? And those were the factors.
Great, thanks so much, Mark. So we have a couple of questions that have to do with the value that ask about the value to the customers. So one is about highlighting the fact that the clients are very cost sensitive and that digitization comes with additional cost to clients. So how do we ensure that there is customer value despite the additional costs? And then another similar question to customer value that speaks to customer value is how can MFIs convince clients to move to digital products and services? So I know that in the work that was done as part of these pilots with business intelligence, the purpose of the dashboards that MFIs created was to look at the impact of digitization on customer behavior and to look at this as a proxy for value and identify where digitization was leading clients to transact more with digital. To transact with digital and to transact more with digital. So I don't think we have answers to all those questions, but this is definitely the type of questions that the strong business intelligence practice will help institutions get more insights into. And we did get a little bit into that towards the end of the project of looking at where clients were transacting more and hearing from institutions also what their hypothesis on why that was happening. And this is where it gets really interesting to dive into this when you're seeing clients move to the digital products. But I don't know if Mark or Ivo or anyone you want to add to that as well.
I would just say this is the right question to ask. And every institution, this is what the product development cycle needs to look like in the institution. You formulate your best answer to that question and then you test it. And you test it, and then you look and see if customer behavior changes. And in this case, it would be, are more customers renewing their loans? And you should do some qualitative analysis. You should go interview, the customers, go interview your traditional, the customers who renew by your traditional methods, and interview the customers who didn't participate in your automated loan. Say, was this better? There's no magic answer here, but you need to formulate your answer and test it. Now, that said, I think that cost to the customer is huge. Most of us work in microfinance industries where customers they can walk across the street to one of your competitors and they can borrow. And quite frankly, a very obvious place to start is in the pricing of follow-up loans. If you are able to increase your efficiency and you are able to reduce your expense to income ratio, you should be able to pass some of that savings along to your follow-up customers in the form of risk-based pricing, and turning that into an incentive to your customers of saying, hey, if you pay back your loan and you pay it back on time, you become eligible for an automated loan offer that you will receive 2 months before you pay your loan off. And you will receive an interest rate reduction on that for being a good client. This is just let me say, an obvious place to start, and you test that and see, does your customers like that? Does it increase? Do your C customers start behaving like B customers or A customers because they want to get that interest rate reduction? Does it increase your loan renewal rate? So these are the ways you just formulate a response to that question and test it and then measure it.
Isabel, very quickly, I want to just add one point coming again from the demand side research. So again, very anecdotal so far, one institution, but arguably something we'll see across multiple of them, which is that if you're migrating customers to that new solution, and Mark mentioned that it has to be superior solution, it has to be a better experience from what they experienced before. At minimum, it should be perceived as the same, definitely not worse. And it can be very sensitive. For example, if customers perceive, and it may not be the real case, but if they perceive they're getting worse terms using digital channels, they will fall back on the traditional ones. And this is one part, how you productize the whole solution. So how you actually sell it to the customers and how you incentivize them to use digital channels, but also how you communicate why they're getting an offer which they're getting, because my sense is that some of it may be driven by macroeconomic conditions, changes in policy rate and so on. But the point remains the same. If customers try something new and it works worse, or it's perceived as worse, they will default back. And we've seen that in some instances. So just adding, yeah.
Okay, thanks so much. So we have time for one last question, and I will take a question about the role of the regulators, and let you answer that, Ivo. So the question is, what is the role of the regulator in this process, in the digitization of institution, and how to ensure that the vulnerable population that is often not well informed about technology and knowledgeable about technology be protected? So Ivo, do you want to answer that? And then we will move on to the closing session.
Yes, so I'll just very briefly say that we just did this out, as mentioned, across different contexts and different legal and regulatory frameworks. And so not surprisingly, we've come across some of the regulatory challenges that MFIs face when they, generally in their operations, but also when they want to digitize. So I mentioned a few of them, and it kind of alludes to what regulator can do. Of course, what regulator can do is then to address those challenges and remove the barriers that exist. I also want to acknowledge that there are probably many more, but these kind of tend to repeat. So one of them has to do with cloud computing and the data residency. We've been using solution, as Mark mentioned, that is software as a service, which requires a cloud-based a data warehousing. And that means that some of the data travels across jurisdictions. So now when that is prohibited or severely constrained, that solution may not be available. We can only expect that in the future there will be more and more dependence on cloud-based solutions with artificial intelligence, machine learning. More and more tools will likely become part of the cloud-based value proposition. And so regulators that do constrain usage of cloud-based solutions will probably find their markets struggling with modernization. The other issue is around sort of the legacy rules that require in-person contact for customer onboarding, verification, creditworthiness assessment, and so on. So there are countries that still do have those requirements. In fact, there are countries that have those requirements imposed on microfinance, while they may not be imposed on other types of lenders. And so that again creates a barrier. If you think about the credit renewal process that we've done, if at any point of time microfinance institution is expected to engage in a sort of more heavy in-person communication with the customer, it creates a slowdown in that implementation that may not completely defeat, but definitely diminish the efficiency gains. And of course, the last one I'd like to mention is the point around deposit taking. So we know that there are jurisdictions that don't allow microfinance institutions to take deposits. It comes with certain trade-off of what prudential requirements are then imposed on lending-only microfinance institutions. But generally speaking, of course, the more microfinance institutions can offer, the better, in a way, the value proposition they can play with, even in the digitization context. So, Isabel, I think we're kind of wrapping up this part, right? So I would just ask maybe Daniel to put the slides back on and close this part so that we can transition into the next one. So please, if you're interested, stay on the line, because in the next part you will hear from microfinance institutions, Rubik's, and also our data specialist on the technical details of what we exactly did in the projects. So, Daniel, if you can just move ahead to the slide that says a vision for the future of microfinance, or maybe sorry, the slide that is right after the closing part one. Yes. So I'd like to kind of lay down a potential roadmap that we've been thinking about and sort of playing with. The first two steps on the staircase you see here is what we did in our pilots. We have helped microfinance institutions to think more about the business intelligence, to make it really a bedrock of their digital efforts, to help them to analyze their customer behavior through the lens of data that they already have, and use those insights in digitization efforts and in improving their digital solutions. And we really think that's the stepping stone for anything else. So if you are starting, you should be probably starting looking at your business intelligence and data analytics capabilities before moving ahead. The second stepping stone here is streamlining the credit renewals. And I think Mark made the case that for us, it was a focus area because we believe that for majority of MFIs, this is such a significant portion of their business and source of revenue. I mean, the credit renewals, that streamlining that piece would help dramatically to improve their business. In fact, when we were selecting the partners for this project, we've reviewed over 100, maybe even actually over hundreds of applications. And we look at the different processes that MFIs apply to credit renewals as opposed to the first-time loans. And very often we found that those processes are exactly the same. So even if the customer is already known to the microfinance institution, he or she is still being reviewed exactly the same way he or she was reviewed when the first application was filed. So there's a huge potential for streamlining that with technology or without. But interesting question that we haven't really answered is, what are those other steps? What are the other use cases that may be less obvious? And so next slide, we don't quite know what they are, but we believe that once you establish the solid business intelligence practice, once you have a good use case that kind of builds the confidence and brings some efficiencies, then there are different ways that MFIs can go. And here are just some of them. It could be that they just follow the incremental digitization. So they would basically start building other use cases, improving them further, turning into the back office and back-end operations, and just kind of building step-by-step the digital practice. It could also be that they decide to shift to a new business model, or at least to a specific customer segment based on their insights on how customers respond. They may decide to focus on digital customers, the super users, the micro entrepreneurs, because they may see that that is really the business opportunity that can be further explored with technology. And they can also explore new partnerships in what we call modularized financial markets with fintechs, banks, other digital players, because those base two steps, or actually even the first step, which is the business intelligence, improves capacity to partner and integrate with digital players, and that could also include e-commerce platforms. So this is not to say that these are only the three ways and these are the most important ones. This is just to say that the digitization process opens up opportunities for a new strategic decisions and new strategic directions that MFIs can take. So let me conclude on the next slide, saying that for CGAP, the vision for the future of microfinance is where microfinance is part of a competitive market that comprises a range of providers, from digitized incumbents to scaled innovators, and that is responsibly addressing the needs of all underserved segments with efficient and effective offerings. And we believe that to achieve that vision, digitization is a critical enabler, but focus should be on the value that microfinance institutions have been providing over past decades to the lower income, excluded, and underserved customers, the segment in which microfinance institutions remain uncontested even by those new digital lenders. So let me conclude on that, and let's, Isabel, transition to part 2 of our workshop.
Great, thanks so much. So before we transition to part 2, actually, we wanted to do another poll and hear from you based on this workshop. What are your thoughts after having heard what we shared in part 2 of this part 1 of this workshop? So if you could select all the answers that apply here in terms of what you're interested in learning more about. Are you interested in learning more about automatic credit renewal or business intelligence, or are you ready to implement business intelligence? Anyway, we're interested in hearing where you are in the spectrum of wanting to learn more or ready to implement either of these solutions that we have discussed. So we'll give you a few minutes for this, and then we will move to part 2. And for those of you who are selecting other, if you wouldn't mind putting in the chat what is this other, what are the other things that come to mind as next steps for you after part 1 of the workshop. We'd love to hear about that. Okay, so let's close this poll. Thank you very much for your answers. So we see there's a lot of interest in learning about both topics. And some of you are also ready to implement those solutions. So again, we'll talk more about that in the next session. But please feel free to put more details also in the chat. We're definitely interested in continuing to be engaged on the topic. So we have a couple more questions for you before we move to part 2. A couple of word clouds again. what was most useful about part 1 of this workshop? So please let us know what you found most helpful. And then the next question will be, what is missing? So if you're thinking about missing or things you wish you would have learned more about or thought were missing, then please keep those in mind for the next question that we will put up. And sorry, this is actually not a word cloud, so my bad. Wanted to give you a chance to write more than a few words, so we will look at those answers. So we'll give you a few more minutes, and then we'll move on to the last question, that is what was missing. Okay, so 30 more seconds and we'll move to the next one. Okay, so let's move to the last one. The last one is what was missing from part 1 of the workshop. So again, we invite you to give us your feedback. This feedback is incredibly useful for us. So thanks to all of those who are writing right now. We'll keep it open so that this gives you time to continue to write your thoughts, and we will look at this with a lot of interest. So please go ahead and continue to write this. We are now ready to transition to part 2 of this session.